Welcome. We're standing at a historic pivot point. Today, we're dissecting the 2026 energy systemic shock. This isn't just about rising gas prices. It's about a fundamental realignment of global power, capital, and survival. Let's dive deep into how a 21-mile choke point is rewriting the future of industry. Asia is the world's factory, but it has a fatal flaw. It's running on a Middle East life support system. Despite the hype around EVs, China and India still depend on imported crude for over 75% of their energy needs. If the blood stops flowing from the Middle East, the world's factory floor goes dark. This is the Strait of Hormuz, 21 miles wide. That's it. Through this tiny gap flows 25% of the world's LNG and 21 million barrels of oil every single day. In geopolitics, this is the global jugular. If this vein is constricted, the global economy doesn't just slow down, it suffocates. Our models show a vertical surge. We're not talking about a gradual increase. If Hormuz closes for just 1 month, we're looking at $180 oil. At 3 months, $250. This isn't market volatility. It's a physical breakdown of the supply-demand curve. China has built massive petrochemical capacity, but it's caught in a naphtha trap. Unlike American plants that use cheap gas, China uses oil-based feedstock. When oil prices spike, their margins don't just shrink, they turn negative. They are literally losing money on every ton of plastic they produce. For India and Southeast Asia, this isn't just an energy crisis, it's a food crisis. When oil and gas spike, the price of urea and fertilizers skyrocket. We are looking at a direct threat to crop yields and social stability across the global south. Japan and Korea are the energy islands. With near 95% dependency on Middle Eastern crude, their currencies are being crushed as they trade weak yen and won for expensive dollars to buy oil. This is a massive wealth transfer from east to west. Contrast this with the United States. Thanks to the shale revolution, the U.S. has built an energy fortress. While Asia is panicking about tankers, the U.S. is sitting on a domestic ocean of ethane. In this crisis, the U.S. isn't just surviving, it's preparing to take over the global market share. The market is having a great shakeout. Look at the cost curve. U.S. and Middle East gas-based producers are sitting pretty at the bottom. Asian naphtha-based producers are at the top, facing extinction. The high-cost producers are being liquidated by geography. Europe is witnessing a terminal de-industrialization. Without cheap Russian gas or stable Middle East oil, their chemical giants like BASF are moving their capital to the U.S. and China. The industrial heart of Europe is being hollowed out in real time. So what's the play? Survivors are focusing on integration. You can't just be a refiner anymore. You have to be a molecular engineer. The shift from commodity fuels to high-end battery materials and specialty chemicals is the only way out. As we look at the risk matrix, the verdict is clear. North America is the safe haven. Europe is in systemic decline. Asia is the growth at risk. We are moving from a world of just-in-time efficiency to just-in-case sovereignty. In 2026, energy security isn't about price, it's about physical control. If you don't own the molecule and the route it travels, you don't own your industrial future. Resilience is the new ROI. The era of globalization 1.0 ended in 2024. 2025 was the shock. 2026 is the year of resource blocks. We are seeing the birth of a fragmented, polarized energy map that will last for decades. The map is being redrawn. We are seeing a tripolar world, the American fortress, the Eurasian pipeline block, and the volatile South. Your investment strategy must adapt to this new geography of risk. The map of the world is being redrawn by energy molecules. To navigate this complexity, you need data, not just headlines. For the full-page deep dive, reach out to us at HDIN Research. The future belongs to the resilient. See you in the next analysis.